ready to go. Can you hear me clearly?
Yes, I can. How are you?
Can you turn up your volume just a little bit for me?
Sure. How's that?
That's a little bit better. Hopefully everyone can hear us clearly. But welcome everyone to Wednesday Strategy Nuggets with me, Natashaewing.johnson. I am your real estate strategist, and I am super excited to introduce one of my favorite lenders, Gloria Sal Rodriguez, to you today. Just a little bit about Gloria Sal. She has been in the mortgage industry for over 5 years now. And for her, my winnings, some of the things that really stand out to her about me is she's one of the few lenders that actually show up for all of my closings. And she has done an amazing job connecting with clients, being able to explain to them what's going on in the market, what to expect through the loan process, and really stepping people through methodically the loan process, which is an exceptional thing to do in the current environment we're in. So she is kicking off my series of Wednesday strategy nuggets with sessions with various lenders, vendors, etc. And I am super excited to introduce her today. So this is going to be a relatively, we're going to get straight to the point. Interest rates are on the rise, and there is a lot of concern in the market from buyers and sellers alike regarding what the market is doing and what it is selling. And we had an opportunity just to have a dialogue last week. We went to lunch and we had a great time, but we started talking about the market, what's going on in the market, what should buyers be expecting in terms of interest rates, etc. So I want to start out first with just talking about the interest rate. Interest rates are rising. We're anticipating that they're going to see an additional rate hikes, but what does that mean for buyers right now? I want you to speak a little bit to that because, I'm seeing buying power is shrinking a little bit, but we want to ensure that we are understanding that comparatively speaking, these rates are not as high as people think they are. People are running scared because of inflation, but I want people to rest assured that the rates are not as high as they think they are. So let's start talking a little bit about that because, people are comparing today's rates to what the pandemic rates. So talk a little bit about that so that people can understand where we are concerning a rate situation. And we're going to dive into some other things.
Yes. So rates are, on the rise. They have increased a bit. The most important thing to remember is that during the pandemic, it was obviously a very unprecedented time. I hate to use that word because it's overused, but it really was like nothing we'd ever seen before with everything, shutting down. And so the Fed essentially lowered mortgage rates to the lowest rates that had ever been in history in an attempt to pump the economy. So they wanted people to spend as much money as possible to get the economy back going, revolving again. If you look at rates historically, and I'm actually going to screen share real quick from the Freddie Mac site. So you can look at kind of where rates have been historically over the past 30, 40 years. If we look here at our peak early 80s, so when our parents are buying homes, look at the 30-year fixed rate. It was 18%. That's what the rates were early 80s. Going toward the mid 80s to early 90s, you see rates drop a bit. So you'll see them go down to about the 10% mark. It's starting in the mid 80s. But really, they didn't drop again until the early 90s when they went around 7%, and rates never dropped below 7 for an entire decade. So we're talking from the mid 80s through early 2000s, we never saw an interest rate below, 6 to 7%. It wasn't until 2010 that we saw rates go to the 5% mark or below. So really, when you look at the last 40 years of mortgage rates, the last 10 years is the only time in history that we've seen rates at 5% or less. And of course, in the last couple of years, we saw them at historical lows because of the pandemic. So it's good to note that this is when we look at rates historically, they, between 10 and 7% for 20, 30 years.
So basically rates are normalizing again, right? We're back at the normal trend for and so a lot of people like, well, I'm going to wait till rates drop again. Are we really going to see a pandemic rate again? I mean, in looking at all the statistics and looking and listening to some economists and what to expect, do we anticipate that they're ever going to be, because I know people that were able to even get in with 2.5%, 2.2%.
Yes,
are we ever going to see that again?
No, fortunately and unfortunately, but no, rates are not projected to ever go back to those pandemic lows. And honestly, it backfired. The rates were so low that it actually backfired. And now the Fed is reversing course because they basically lowered the rates too much. So we will not see them go back down to that 2.75, 3%, 30-year fixed rates again. We will see them go back to what we say really is truly normal. Right now, the market is, just below 6%, paying 1 point, which is 1% of your loan amount in fees. That's about the average right now. There's a lot of factors that also affect the rates. A lot of people think, oh, it's just my credit. There's actually about 32 different factors that affect your interest rate. So they're looking at your ability to repay the loan, and they're also looking at lots of factors, not just your credit score, but how much do you have in reserves, meaning if you lost your job, how many months of savings do you have? The more savings you have, the less likely you are to default on your loan. Is there more than one borrower on the loan? If two borrowers are on the loan and they're both working full time, then even if one borrower lost their job, we know that the other borrower could probably cover that mortgage before they would default. So that's, there's a lot of factors that go into the rate. But right now, even though we're seeing a rise in interest rates, it's still historically pretty low rates considering, if you look at the 80s, 90s, early 2000s, we're still much lower than rates were back then.
So yeah, and that's excellent information to have going in. So what does that mean for a buyer? Basically, during the pandemic, you may have been able and pre-qualified for maybe a $300,000 house. You will have to now cut back a bit and look at maybe a $250,000 house because your payment is going to be higher, and therefore you have to adjust concerning the price. So we want buyers to be aware of that fact that going into buying now, that you just have to have a mindset shift. You will not be able to afford. And if you got a pre-approval 90 days ago, you probably need a new pre-approval because that rate has changed. And what you qualify for is going to be definitely different. And those people that keep saying they're going to wait it out and wait it out, I think that waiting process is starting to backfire on them because now rates have increased to a point where I'm seeing buyers not being able to afford what they previously could afford 6 months ago, 90 days ago, or even a year ago. That has shifted tremendously. And honestly, as a real estate agent, monitoring the market, looking what's going on there, prices are not going down. They continue to trend upwards. Now, we're not seeing the double-digit growth, but we are seeing a continued trend upwards in the home value and the prices of homes.
Yes, and that's a very important point because a lot of people think, oh, a 6% interest rate, I can't pay that. But keep in mind, if the home values in Metro Atlanta increased almost 20% last year. So if you're paying 23%, there you go, you're the expert. So if you're paying a 6% interest on a home, yes, that's higher than when rates were, very, very low. But if you're getting 20% increase in the value of the home, you're still getting, even if you're only getting a 10% increase in the value of the home, you're still getting a return on your investment. And let's also keep in mind that rent prices have increased 20 and 30% some places. So even though, the interest rate on your mortgage is a bit higher right now, you're getting the appreciation on the home value, and the rental market is actually much more competitive than the mortgage market is right now.
Absolutely. I would totally agree with that. I mean, the rental market now, because of the raised values, a lot of landlords have raised rents. There has been initiatives throughout the Metro Atlanta area to help stabilize the rise in rents. So renting affordability is not there. And listen, I've heard it said, and I totally agree with it. Rent, you're paying 100% interest. The
Right.
people are opting to rent. They're like, oh, well, we'll rent for another year. Well, until interest rates go back down. Well, okay, you're paying 100% versus paying 6% because basically you're getting nothing back from the rental on that home. There is so much that you can to gain from purchasing a home, not just in the tax write-offs and the benefits of owning your own property. You're also getting the appreciation and the value of that home. You're able to gain equity. You're getting 100% of zero equity on a rental.
Right. I always tell people you can either pay for your own mortgage or you can pay for someone else's mortgage.
Yeah.
Each month you're paying, and if you're renting from someone, then you're just paying their mortgage payment.
Absolutely. So what are some creative strategies we're looking at? Because some people are like, oh my gosh, now I got to put, the rates are so high. I know you and I talked about the ARM is coming back. And I want to just talk a little bit about that. What does that mean? Some of that is scary to people, like, oh my gosh, an adjustable rate. That's a little bit scary. So talk to me a little bit about, I want to talk to you a little bit about the ARM and then a couple of the other products that Atlantic Union has that are really excellent products that I've leveraged before. So let's talk first about the ARM.
So the ARM is a variable rate, right? And it can adjust with the market, and that scares a lot of people. But the good news is there are long-term ARMs. So we have 7, 10, 15-year ARM options. So that means that your interest rate is fixed for the term of the ARM. So 7 years, 10 years, 15 years, and then it can adjust with the market. But you have the opportunity to refinance before that time. So, we as your lender definitely monitor the market for you. And if rates are lower at that time, then you're just fine. If rates are anticipated to be higher than what you have, or that your rate's going to adjust, then you have plenty of time to sell or refinance. And in 7 to 10 years, you've paid down quite a bit of principal. Your home value would have increased significantly. You have quite a bit of equity in the home. So you have a lot of options. So, we're not talking an ARM where the rate's going to adjust every year for the next 2 years. It's not like that. It's longer term.
Longer term.
You got 7, 10 years, sometimes 15-year ARMs. So you have plenty of time. It's 50. Most people statistically sell or refinance, even with the 30-year fixed loan. They sell or refinance within 3 to 5 years. Yeah. So typically anything longer than 5 years, you would be refinancing most of the time anyway. Yeah.
So the ARM rates are lower than the regular 30-year conventional rates. So that's an option too, to help with your affordability moving into a home. One of the other products that I love, I've closed a couple, maybe 3 or 4 deals with it, is the STAR program. You have 100% financing program called the STAR program. Talk a little bit about that, because it's a conventional product. Yes. And for those that meet the credit qualifications, it's an excellent opportunity for you to just get into a home with 100% financing, just focused on your closing costs.
Right. So with the increase of rates and fees at closing, most people, the issue they have is they have great income, sometimes great credit, but it's that down payment and closing costs. Typically, for a first-time home buyer, you need 3% of the purchase price for the down payment, and then you need an additional probably 4% at minimum for the closing costs. So that can be a good amount of money, and you might not have all that liquid assets at the moment. So one option we have is our 100% financing product called the STAR program, Steps Toward Achieving Results. And it's for borrowers that have good credit, good income, solid income, but don't quite have all of the assets put together, the down payment and the closing costs. They don't have that full 7% on hand. So what we do, we finance the down payment. The borrower just has to come up with the 3 to 4% for closing costs. It is for borrowers that live at or below the median household income for Metro Atlanta. For Metro Atlanta, it's $96,400.
Okay.
Household income. So if spouses both work, we would look at the incomes combined. But if your household income is $96,400 or less, and your credit score is 700 or better, then you can get 100% financing. So that means that all you would have to come up with would be the 3 to 4% in closing costs, and you could close on your home. On the other side of that, if the credit score is just a little lower, say 660, 680, you could do 3% with the STAR program. There's no PMI with it. It's still a conventional product. So when you're in the 660, 680 credit score range, that's typically FHA approved loans, and a lot of those are just harder to get under contract right now, unfortunately, in the seller's market that we're in. So this allows somebody with a 660 or 680 score to get in with actually a lower down payment than they would for FHA. There's no upfront premium like FHA requires, and they have a conventional pre-approval as opposed to an FHA pre-approval, which has a little bit more weight in this market.
Okay, that's awesome. I like that approach in terms of, I've used the STAR program. A couple of my clients have closed successfully with STAR. I think it's a great option, especially for those that have, funds available for closing costs, but they're struggling a little bit more with the down payment. And then I love the no PMI option, because that gives them less of a mortgage payment, right? I'm trying to figure out how to get rid of my own personal PMI now on my home. We talked a little bit about that. So, these are some things that, and I am always looking for creative strategies and solutions to help buyers and sellers, because, from a selling perspective as well, we've got to be very cognizant of the market and what homes are. And there is still an inventory shortage, guys, out there. So I want to make you aware of that yes, there are buyers in the buyer pool. The Atlanta market does have some unique dynamics. We are becoming the Hollywood of the South. Movie studios are popping up all over the place. So our buyer pool is shrinking, but it's not gone. There is a ton of buyers still out there. We still have an inventory shortage. So yes, it's still a seller's market, but I do want buyers to be aware of what's going on with the market, what's going on with interest rates, so that they are educated. My goal is to educate and become your trusted advisor and identify those strategies to help you win in the real estate arena. So with that said, I want to say thank you to Gloria Sell. This is a short snippet. Today for my wisdom strategy nuggets here with me, Natashaewing.johnson, your real estate strategist, giving you tools to win in real estate.
Thank you.